Welcome to an in-depth examination of global currency dynamics in a new era marked by political and economic fragmentation. Today, we explore how central bank pressures and trade policies are reshaping the global finance landscape and influencing the world's key currencies. The international financial system is fragmenting. Central banks are losing their traditional independence, while tariffs and trade measures are increasingly wielded as geopolitical weapons. At the heart of this transformation is the US Federal Reserve. Political pressures from the White House are intensifying, challenging the long held notion of the Fed's independence. Fiscal realities complicate the picture further. The US national debt has soared to an unprecedented $37 trillion, with key interest payments now consuming more than 40% of the federal income tax. This fiscal dominance means aggressive rate hikes risk destabilizing government finances. This tension breeds two contrasting views: that we're already in stagflationary environment of low growth and high inflation despite Fed denials, and two, that political forces will force the Fed into premature rate cuts to support fiscal sustainability. Evidence of this politicization is clear. Unprecedented dissent within the Fed's Board of Governors favors rate cuts, and Fed Chair Powell's public acknowledgements of downside employment risks signal an easing guidance. Markets are reacting accordingly. Short-term rates are falling in anticipation of cuts, but the long-term inflation premium is rising sharply, creating a steepening yield curve expected to widen through mid-2026. This reflects deep concern that the Fed's policy may remain too loose for too long, risking future inflationary shocks. Across the Atlantic, the euro is defying expectations by showing relative strength amid significant domestic political turmoil. The European Central Bank has maintained a steady policy stance, resisting the political upheavals that have shaken the Eurozone, such as the ongoing crisis in France, where a stringent 2026 budget proposal threatens government stability. This political risk elevates yields on French sovereign debt close to levels last seen in the Eurozone debt crisis. Yet, the broader Eurozone bond market remains remarkably stable. The market's confidence in the ECB, bolstered by mechanisms such as its transmission protection instrument, seems to outweigh domestic uncertainties but stressing the euro. Moreover, the US dollar falters under domestic political strain. Investors actively seek alternatives, giving the euro's gradual appreciation resilience, projected to reach around 1.20 levels by spring next year. Japan's yen, long considered a global safe haven, is caught in a complex geopolitical and economic blind. While the Bank of Japan planned a cautious normalization of interest rates, targeting a neutral range of 1 to 1.5% by 2026, the emergence of targeted US tariffs has severely impacted the Japanese export performance. In July, the exports to the United States plunged by over 10% year on year, the steepest decline in more than 4 years. Exports to China and Europe also fell, forcing Japanese exporters to cut prices to stay competitive. This tariff shock is more than economic, it's geopolitical. The Bank of Japan's governor described these US tariffs as part of a broad movement encompassing economics, diplomacy, politics, and culture. As a result, the yen is failing in traditional role as a safe haven during instability, weakening rather than strengthening in turbulent times. Evidence of declining confidence is also seen in Japanese megabanks' growing purchases of foreign bonds, including US treasuries, as domestic investors seek safe assets abroad. Forecasts for the yen's trajectory diverge widely. Some banks project dollar yen to reach 140 by year end, others as high as 145, reflecting the uncertainty driven more by geopolitics than economic fundamentals. Perhaps the most dramatic currency today is the Indian rupee. The US government has imposed severe tariffs approaching 50% on Indian goods, along with a punitive 25% tariff on continuing purchases of Russian oil, a move designed more as a geopolitical tool than a corrective trade measure. The multi-purpose geopolitical hammer has pushed the rupee to historic lows near 88.24 per dollar, making it Asia's worst performing currency. The tariffs could cost the Indian currency up to $60 billion annually and reduce the GDP growth by 80 basis points annually. Yet, this aggression has catalyzed a strategic response, accelerating India's economic realignment away from the US financial system. Over 90% of bilateral trade between India and Russia now settle in their national currencies, the rupee and the ruble, bypassing the traditional dollar clearing. This marks the formation of a potentially formidable anti-US economic bloc that integrates military, manpower, economic and technological power. India's robust domestic economy, anchored by strong consumer demand and infrastructure spending, supports this long-term shift despite short-term economic pressures. What does this evolving picture mean for the global currency environment? The dollar's dominant role is being chipped away by political interferences and fiscal constraints that undermine confidence and encourage de-dollarization. The euro stands as a pillar of relative stability due to the European Central Bank's steady policy and investor trust despite political challenges. The Japanese yen contends with the repercussions of geopolitical shocks that weaken its safe haven status and complicate monetary policy normalization. The Indian rupee embodies the geopolitical shift where economic coercion triggers strategic currency realignments and a push towards alternative financial blocks. For ongoing insights into global finance, currency trends and geopolitics, subscribe and stay connected with Myforexeye. Thank you for watching.